Let me start with a question that should keep you awake at night. As of 2024, global public debt has reached $102 trillion. The United States alone owes $38 trillion. Japan owes nearly 300% of its gross domestic product. European nations are drowning in debt. China, despite its massive reserves, carries enormous hidden liabilities. Developing countries are paying almost $1 trillion just in interest payments every year. So here's the puzzle. If everyone owes money, who exactly are they paying? Who is this mysterious creditor that the entire planet is indebted to? Are we borrowing from aliens? From future generations? Or is something far stranger happening right under our noses? The answer reveals the most elaborate shell game in human history, and understanding it is crucial to grasping why our economic system functions the way it does, why inequality keeps growing, and why nations that print their own money somehow find themselves unable to pay their bills. Let's start by dismantling the comfortable myth we've all been fed. When we think about debt, we imagine it like household debt. You borrow money from someone who has it, you pay them back with interest, and the transaction is complete. Simple, right? But sovereign debt, the debt of nations, works nothing like this. And that's where the magic trick begins. Take the United States. The federal government has $38 trillion in debt. Who holds this debt? Well, about $7 trillion is held by foreign governments, primarily Japan and China. Another $6 trillion is held by the Federal Reserve, which is technically the United States' own central bank. The rest, the largest chunk, is held by American institutions and individuals, pension funds, insurance companies, mutual funds, banks, and wealthy investors. Now, here's where it gets interesting. When the United States government needs to borrow money, it issues Treasury bonds. These bonds are sold at auction. But who buys them? The primary dealers, a group of about 24 large financial institutions, are required to bid at these auctions. They buy the bonds, then immediately turn around and sell them to their clients. Those pension funds, insurance companies, foreign governments, and so on. But wait, where do these institutions get the money to buy government bonds? This is the crucial question. Pension funds get money from workers' paychecks. Insurance companies get money from premiums. Banks create money through lending. And wealthy individuals accumulate money through returns on their existing capital. So in effect, when a government borrows, it's borrowing from its own economy. It's borrowing from the savings of its citizens, mediated through financial institutions. The government takes money out of the private sector through bond sales, spends it on various programs, and that money flows back into the economy. Then it taxes some of that money back to pay interest on the bonds, which goes back to the bondholders who are themselves part of the economy. It's circular. The snake is eating its own tail. But here's the key. It's not a closed circle. There are leaks. There are accumulations. There are power dynamics that make this circular flow anything but neutral. Let's follow the money more carefully. When the United States government issues a $1,000 bond at 3% interest, someone buys it. Let's say it's a pension fund. That pension fund pays $1,000 today and will receive $30 every year, plus the $1,000 back at maturity. Where does the government get the money to pay that $30 in interest? From tax revenue primarily. Now, who pays taxes? Everyone does, but not equally. The tax system in most developed countries is nominally progressive, meaning higher earners pay higher rates, but it's full of loopholes, deductions, and capital gains preferences that benefit the wealthy. Meanwhile, who owns the bonds and collects the interest? Disproportionately, the wealthy. Pension funds serve workers, Yes, but the bulk of financial assets are held by the top 10% and especially the top 1%. So we have a system where the government borrows from the wealthy, pays them interest, and funds that interest through taxes collected from everyone, but with the wealthy paying a smaller effective rate than their share of wealth would suggest. It's a transfer mechanism, moving resources from the general population to bondholders, mediated through the government. But it gets even more complex when we introduce central banks. Let's talk about quantitative easing, a term that sounds technical and boring, but represents one of the most significant economic interventions in modern history. During the 2008 financial crisis and again during the COVID-19 pandemic, central banks, particularly the Federal Reserve, engaged in massive bond buying programs. The Fed's balance sheet grew from less than $1 trillion before 2008 to nearly $9 trillion at its peak in 2022. How did it do this? Did the Fed have $9 trillion sitting in a vault somewhere? Of course not. It created the money electronically out of nothing and used it to buy government bonds and other securities. Think about what this means. The government issues debt, and its own central bank buys it with newly created money. The government now owes money to itself, essentially. The interest the government pays on these bonds goes to the Federal Reserve, which then returns most of it to the Treasury as profits. It's a closed loop, almost like the debt doesn't exist. But it does exist in a way because that newly created money is now in the economy. When the Fed bought bonds, it paid whoever was selling those bonds, usually banks and financial institutions. Those institutions now have cash instead of bonds. That cash can be lent out, invested, used to buy other assets. The money supply has increased. And when the money supply increases faster than the production of goods and services, you get inflation. So quantitative easing is really a way for the government to fund itself by printing money, but doing it indirectly through the bond market to maintain the appearance of fiscal discipline. And who benefits most when asset prices rise due to increased money supply? Asset owners, the wealthy. Again, now let's zoom out to the global level, because this is where the paradox becomes even more striking. As I mentioned, global public debt is over $100 trillion. But remember, one country's debt is often another country's asset. When China buys United States Treasury bonds, China is the creditor, the United States is the debtor. When European pension funds buy German bonds, they're the creditors, Germany is the debtor. But here's the thing. In aggregate, when you add up all the debts of all the nations, you get that $100 trillion figure. And when you add up all the credits, all the assets that are claims on those debts, you get the same $100 trillion. They balance. They must balance because every debt is someone's asset. So, in a sense, the world as a whole doesn't owe money to anyone outside the world. We haven't borrowed from Mars. The debt is internal to the global economic system. It's a set of claims that various parties have on each other, mediated through the financial system. But here's why this matters. The distribution of those claims is wildly unequal. As of 2024, 62% of developing countries' external public debt is owed to private creditors. These are bondholders, banks, investment funds, mostly based in wealthy countries. Developing countries are paying $921 billion per year just in interest on their debt, a 10% increase from 2023. Let me put that in perspective. 3.4 billion people live in countries that spend more on interest payments than on either health or education. In the poorest countries, debt service absorbed $96.2 billion in 2023, with interest costs alone at $34.6 billion, 4 times what it was a decade ago. In Africa, debt service takes up 54% of government revenue and 40% of spending. These countries borrowed money, often from multilateral institutions like the International Monetary Fund and World Bank, or from private creditors, or increasingly from China. They borrowed to build infrastructure, to develop their economies, to cope with crises, but the terms were often harsh, the interest rates high, and the debt service payments have become crushing. And here's the cruel irony. Much of this borrowing was necessary because of the structure of the global economy itself. Developing countries need foreign currency, usually dollars, to buy imports, to service existing debt, to attract investment. They export commodities and manufactured goods, but the terms of trade often work against them. The prices they receive for their exports are volatile and often declining, while the prices they pay for imports, especially technology and capital goods, keep rising. So they borrow dollars to fill the gap. And who lends them those dollars? Wealthy country institutions and investors who are flush with dollars precisely because the global system funnels dollars to the financial centers of the world economy. The developing countries are trapped in a debt cycle, paying interest to the very countries and institutions that benefit from the unequal structure of global trade. Let's talk about China for a moment, because China's role in global debt has transformed dramatically. Over the past 2 decades, China became a major creditor to developing countries, lending hundreds of billions of dollars for infrastructure projects through its Belt and Road Initiative. As of 2023, more than a quarter of external debt in developing countries was owed to China. But here's what's changed. In 2024, China's net flows to developing countries dropped to negative $34 billion. China has transformed from a capital provider to a debt collector. Countries are now paying China at least $35 billion per year, and China is lending less new money. This is creating a severe crunch for countries that were counting on continued Chinese financing. Why did China do this? Partly because many of its loans aren't being repaid on time. China is facing its own domestic economic challenges and can't afford to keep lending without returns. But this leaves developing countries in a terrible position, squeezed between their need for development finance and the demands of their existing creditors. And when countries can't pay, what happens? Debt restructuring, a process that has become nightmarishly complex. Under the G20 Common Framework, heavily indebted countries can seek debt relief. But only 4 countries, Chad, Ethiopia, Ghana, and Zambia, have even applied, and the process has been painfully slow. Why? Because the creditor base is now incredibly fragmented. It's not just official bilateral creditors like other governments. It's not just multilateral institutions like the IMF. It's also private bondholders, Chinese policy banks, commercial banks, and other private creditors. Getting all these different creditors to agree on haircuts, on who takes losses and how much, is incredibly difficult. Each creditor wants to make sure others aren't getting a better deal. The process can take years, during which the debtor country continues to struggle. Let me bring this back to the core question: who is the lender? The answer is that we are collectively, but very unequally, when you have a pension, when you have a savings account, when you have insurance, some of that money is invested in government bonds. So in a sense, you're a creditor to your own government and to other governments, but the bulk of these claims are held by institutional investors and the wealthy. Pension funds in wealthy countries hold trillions in assets. Insurance companies hold trillions more. Sovereign wealth funds, mutual funds, hedge funds, all accumulating claims on governments around the world. And here's the thing about these institutions, they need somewhere safe to park enormous amounts of money. Where can you invest $100 billion safely? You can't just put it in a checking account. There aren't enough quality corporate bonds. Real estate is too illiquid for that scale. So they buy government bonds, especially bonds from stable, wealthy countries. This creates constant demand for sovereign debt, which allows governments to keep borrowing at relatively low interest rates. As of 2024, central bank holdings of domestic sovereign bonds in OECD countries fell from 29% in 2021 to 19% in 2024, while foreign investors' share grew from 29% to 34%. The market absorbed what central banks were no longer buying, but there's a hierarchy in this system. United States Treasury bonds are considered the safest asset in the world. The United States can borrow at very low rates. German bonds are also considered very safe, but developing country bonds, they pay much higher interest rates because they're considered risky. This creates a doom loop. Countries that most need affordable financing pay the highest rates, making their debt more difficult to sustain, which makes them seem even riskier, which raises their rates further. And when a country gets into trouble, when it can't pay its debts, the IMF often steps in with a rescue package. But these packages come with conditions: austerity measures, structural adjustments, privatizations, cuts to government spending. The burden of adjustment falls on the population, especially the poor. While foreign creditors are protected, there's a fundamental asymmetry here. When a private company can't pay its debts, it goes bankrupt. There's a legal process, assets are liquidated, creditors take losses, and the company either reorganizes or disappears. But countries can't disappear. There's no bankruptcy court for nations. Instead, there's negotiation, restructuring, and often decades of economic stagnation while the country tries to pay down debt. Argentina is a perfect example. The country has defaulted on its debt 9 times in its history. Each time, it goes through years of negotiation with creditors, implements painful austerity, sees its economy shrink, then eventually reaches a deal that allows it to borrow again. Then the cycle repeats. The Argentine people suffer through each crisis, while bondholders eventually recover much of their money, often with the help of IMF packages that prioritize creditor repayment. Let me address a question you might be thinking. Why don't countries just default and walk away? Some do. Russia defaulted in 1998. Argentina has done it repeatedly. But there are consequences. A country that defaults gets cut off from international credit markets. It can't borrow anymore, at least not at reasonable rates. Foreign investment dries up. The country's banks, which often hold government bonds, face crises. The currency often collapses, making imports unaffordable. So countries avoid default if they possibly can, which means they keep paying, keep cutting spending, keep trying to satisfy creditors. This is what's called creditor power, and it shapes economic policy around the world. Now, let's talk about an argument you often hear, that government debt is a burden on future generations. Politicians love to say this. We're mortgaging our children's future, they proclaim. But is this really true? In a sense, no. Remember, government debt is money that's owed to bondholders, most of whom are part of the same economy. When future generations pay taxes to service that debt, they're paying themselves collectively. The money doesn't vanish, it goes to whoever holds the bonds at that time. The real question is about distribution. If the bondholders of the future are primarily wealthy individuals and institutions, and the taxpayers are the general population, then yes, there's a transfer from the many to the few, but that's a distributional issue, not a burden on society as a whole. However, there is a legitimate concern about debt if it's being used unproductively. If a government borrows to invest in infrastructure, education, research, things that boost future productivity, then that debt can pay for itself through higher economic growth. But if a government borrows just to fund current consumption or to pay interest on existing debt, then future generations inherit that debt without getting the corresponding benefits. And this is what's happening in many developing countries right now. They're borrowing just to service existing debt, a phenomenon called debt refinancing. They're not investing in their future. They're trapped in a cycle of paying off the past. Let me bring this to a conclusion by addressing what this all means for the functioning of our economic system. The debt paradox, the fact that everyone seems to owe money to everyone else, isn't really a paradox at all once you understand the structure of the system. Debt is a social relationship. It's a claim that one party has on another. In a capitalist economy, these claims are constantly being created and traded. Banks create money through lending, which creates debt. Governments issue bonds, which creates debt. Corporations borrow to invest, which creates debt. Individuals borrow to buy homes, cars, education, which creates debt. All this debt serves several functions. It allows spending to exceed current income, which can be useful for investment and growth. It creates financial assets that institutions and wealthy individuals need for savings. And crucially, it creates power relationships. Creditors have power over debtors. They can demand payment, impose conditions, influence policy. At the global level, this debt system maintains the current distribution of economic power. Wealthy countries and their financial institutions are net creditors. Developing countries are net debtors. The flow of interest payments from poor to rich countries is a form of tribute, a transfer of resources that perpetuates inequality. Within countries, the same dynamic plays out. Governments borrow from the wealthy, pay them interest funded by general taxation, and face constant pressure to maintain fiscal discipline, which usually means cutting spending on social programs rather than raising taxes on the wealthy. The central insight is this: money, debt, and finance are not neutral technical mechanisms. They're social and political institutions that shape who has power, who benefits, and how resources are distributed. The question, who is the lender when everyone is in debt, is really a question about the structure of power in the global economy. The answer is that we're all lenders and borrowers simultaneously, but some of us are much more lenders than borrowers, and they're the ones who benefit from the system. The financial sector, the top 1%, the institutional investors, they hold the claims, they collect the interest, they shape the rules. And the rest of us, we work, we pay taxes, we watch as public services are cut to maintain debt payments, and we're told this is necessary, that there's no alternative, that we all must tighten our belts. But there are alternatives. Governments could tax wealth more heavily and reduce the need to borrow. Central banks could finance government spending directly rather than through bond markets, though this risks inflation if not managed carefully. Developing countries could cooperate to demand better terms from creditors, perhaps even forming a debtors' cartel. The global community could create a genuine sovereign debt restructuring mechanism, an international bankruptcy court for nations where unsustainable debts could be written down in an orderly way. Creditors could accept that some debts simply cannot and should not be paid, that there's a moral and economic case for debt relief. These alternatives aren't pursued because they would shift power away from creditors, away from the financial sector, away from the wealthy. The current system serves their interests, so they defend it, and they have enormous influence over economic policy. Understanding the debt paradox, understanding who really benefits from the global system of sovereign debt, is the first step toward imagining and building something different. The question isn't really who the lender is. The question is who benefits from the answer, and what are we going to do about it? Thank you.